We are half an hour from the open in Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles in Seoul.
And I'm Yvonne in Hong Kong. Our top stories this morning. Oil prices extending their decline as President Trump announces a ceasefire between Israel and Iran. That's boosting investor sentiment here in the region and sending stocks higher here this morning. But the fighting continues. Israel is saying it's intercepted drone strikes, while Iran's foreign minister denies any agreement on a ceasefire as Tehran is rocked by large explosions. The purported deal follows a measured Iranian attack on a U.S. base in Qatar that was easily thwarted and caused no casualties.
And I'm Stephen Engel in Tianjin, China, where the World Economic Forum annual meeting of new champions is getting away today. We'll be here all day, and tomorrow we'll be speaking to guests about the situation, of course, in the Middle East, plus trade and tech tensions between the two biggest economies in the world, the U.S. and China.
Welcome to the show. We're going to get to the thick of things immediately right now, Yvonne. So you mentioned a couple of things at the very top of the show. The fighting continues. I should also add the confusion also continues. We woke up, of course, in the Asia Pacific to what happened in Qatar. And, of course, shortly after that, the announcement coming out of the U.S. president. And just in the last, literally in the last 5 minutes or so, this post coming through out of Iran that so far nothing has been agreed. But I'm looking at markets. Nothing seems to be moving on the back of that latest headline that just come through. Oil swung a little bit, but right now we're still holding on to those losses, Yvonne.
Yeah, it seems like we're shrugging off these Iran comments for now, still focusing on this ceasefire, this deadline that's supposed to happen around midnight U.S. time. And you take a look where markets and oil markets are looking at, it's really breathing a sigh of relief. Still, right, that plunge that we saw in oil prices, we saw that in Brent just a few minutes ago. And it's basically we've retraced back to the levels that we saw before, of course, this whole conflict began 12 days ago. So certainly, if you take a look at that two-week chart of crude, it's like it never happened in some ways. You got to wonder, though, what are still some of the lingering questions that we have to ask about where this sort of conflict is right now? Of course, we're still waiting for confirmation, official confirmation from both sides.
Yeah, and while we wait for that, we'll continue to track, of course, the ongoings as far as the markets go. And I think the point that Yvonne was just making there, and I guess back to the earlier point as well, coming through out of the post in Iran. I just had to look at that a third time around, and it doesn't seem on face value. Well, first, number one, no agreement, but there was nothing inflammatory, I think, as far as that's concerned. In other words, long story short there, when you look at these markets, the overall narrative is still the assumption that we are moving towards a de-escalation, number one, and that the ball is largely to the point that Iran was making there just now, largely in the hands of Israel. And if they stop, then things will progress as far as that ceasefire is concerned. All that being said, markets on your screens have largely been trading on the assumption that things will be de-escalating from here on. As you can see, Aussie yen's on the way down. Gold futures, of course, as the reversal of that haven is playing suit as well. Taiwan is opening up right now, so that's really leading to a further bump up in equity markets, 1.2%. Let's have a look at where we are as far as oil goes. So Brent was the latest one to open up in the last hour or so. Gap lower by about $2 or $3, even $4, depending on what part of the curve you're looking at here. At about these levels, 69.24. We're coming off lows of the day, but as you can see, still substantially lower all across the energy curve as I speak. Let's have a look at the 10s, please. And just to mention as well, when you look at the treasury markets, bond markets specifically, there is a 20-year bond auction in Japan today. Keep that in mind as we go into the other themes of these markets. And very quickly, going into the open today, dollar weakness, of course, is going to be a theme to watch across the emerging FX space. And what that means really for dollar, China trading at 7.17 right now. And, of course, the pullback we've had very briefly from the weekend or very near the weekend of the band on the Hong Kong dollar, as you can see. We're still trading extremely near that. The fix is on deck. We'll see what happens there. They banker the currency. But as you can see, equity markets are somewhat, Yvonne, breathing a sigh of relief here so far.
Yeah, let's get the latest when it comes to Iran and bring in our Bloomberg editor, Jill Deesis, also Stephen Stepchinsky, who leads our Asia energy coverage. And Jill, I'll start with you. You know, the market's been kind of in a whiplash, really, but at least pricing in some sort of major de-escalation between the U.S. and Iran. And then we have these comments from the foreign minister this morning. How do we kind of square all these together?
Yes, certainly, Yvonne. So I think there's a couple of really key things to sort of pay attention to here. First of all, when you're looking at those comments out of Iran, I think the really key line there is that idea that they're saying, you know, we'll hold fire if Israel holds fire, essentially, right? So, I mean, again, you know, we're still kind of leading on the presumption that, you know, it's Donald Trump that came out, and he's the one that talked about announcing the ceasefire. I think, as with everything Donald Trump, you have to kind of cut through the bluster and try to navigate exactly what that means. To me, the really key question here is what Bibi Netanyahu is actually thinking, what that official comment from Israel is going to be. To me, that's the big key player that we're still waiting for that official comment from. But all that being said, we're still about 3 hours away from when Trump has said the ceasefire is actually supposed to take place. Obviously, we've been seeing all morning headlines flying around about continued military action happening, that you're seeing Israel continue to conduct some strikes. I think that just kind of shows you this is still a bit of an uncertain situation. But to me, I mean, when you look at the retaliation that Iran ultimately took against those U.S. strikes from over the weekend, I mean, targeting a U.S. command base in Qatar, heavily telegraphed, basically telling everybody ahead of time so that they could evacuate. That's not the kind of massive escalation, that you'd expect. That's really more of a symbolic move here. So it does seem like, ceasefire maybe on the table, but we're still waiting for some clarity there. And again, I really think we need to hear from Israel about what exactly is happening over the next couple of hours.
Right. And, Jill, just to ask you as well, and, is it simply a matter of looking at the clock quite literally, because the timestamp that the U.S. president had attached to that announcement is still in a couple of hours. So in the meantime, to your point, right, we've seen explosions in parts of Iran. We've seen deflecting. Of course, they've said Iran has deflected the most intense strike so far since June 13. Do markets look at what's happening or what potentially will happen these next few hours and just largely try and overlook what's going on here because there is that deadline at the end of these next few hours or so?
I mean, potentially, David, but again, I think this really just comes down to waiting to hear more from what Iran and Israel are actually saying. I mean, as of right now, obviously, we've got these latest comments from Iran. Again, I do think that while, there is that line about no agreement being made, to me, the much more critical piece of that is just saying that, it sort of depends on whether, Israel, sort of halts its actions. So to me, I'm looking at this and thinking, we do have this Trump deadline. I mean, it sounds like Trump talked to Netanyahu. He certainly, obviously, is the U.S. is a key player in what's happening here. But again, we're really waiting to hear what Israel ultimately says. And so I think what this is showing you is it kind of, there's an element of, sort of fog of war here where with a lot of these types of action, there's a lot of different players involved. There's a lot of different pieces on the table that you're kind of, dealing with in these really, really sensitive situations. A lot of, actions that have already happened, some of which have been, pretty highly telegraphed. So it does kind of tell us, I think, that you need to kind of wait to see, what happens over the next couple of hours, what sort of official statements you get. It's easy to kind of run into something like this, see a Trump Truth Social post with all of that bluster and those capital letters kind of flying around, sort of, projecting this idea of a ceasefire. But again, I think we have to wait to see what ultimately happens. And then ultimately, it kind of sounds like, if there's a ceasefire that's actually in place, maybe we sort of reset the clock back to where we were a couple of weeks ago, where tensions have de-escalated a little bit. We're back to looking at a situation where maybe, Iran and the U.S. and such are at the negotiating table again, and we're sort of, getting off of the military incursions that we've seen Israel in particular ramp up over the last several days. But again, I think just really points to a picture where there's a lot that's in action here. I think we have to kind of wait and see what some of these official comments are ultimately going to tell us.
Stephen Stapp, let me bring you in. Equity markets look to be putting this behind them. You look at Asian FX, you look at the dollar offer coming through as well. I look at oil markets down about 3%. The risk is an oversimplified, perhaps, interpretation of what's going on, simply looking at price. How are you guys looking at oil coverage day?
Oil traders, when you speak with them, when you speak to the gas traders, to them, this is all done. They don't see any risk to the market. Now, we can discuss ceasefire, we can discuss, strikes that are ongoing, but right now the market is focusing on two things. One, are there any strikes on Iranian oil infrastructure? There isn't, and there hasn't been. Two, has the Strait of Hormuz been affected? It hasn't, and it likely won't be. So the fact of the matter is the oil market is really discounting this recent flare-up. And you can see it through the prices, right? Clearly, oil prices are back below the June 12 level. You're seeing the market take a large sigh of relief. And that is largely because while we've been through potentially the worst flare-up in U.S.-Iranian conflict in decades, oil kept flowing, and trade via the Strait of Hormuz was not affected. So if you're an oil trader looking at your position, it's very unlikely going forward you're going to see any sort of interruption to supply or any change in the flow of oil out of the region. So that means they're going to focus on the fundamentals. And the fundamentals for the oil market, I'm talking supply and demand, that's just bearish. And that's where we are now.
Yeah, talk us through that, right? You mentioned there's widespread expectations that we're going to see oil supplies run ahead of demand in the second half. So where to next when it comes to oil prices? Are we more likely to head back to 60 than maybe the 100, some of the extreme scenarios that we were just pricing in a few days ago?
There are some jokes going around on social media saying that a few days ago we were talking about $150 oil. Now we're talking about $0 oil. You know, we're not now. Of course, oil's not going to go to zero, but I think that's the sentiment, right? You have those two extremes, and we've swung back to this bearish view because yes, we are in a situation where supply is higher, that is going ahead of demand growth. Chinese demand growth has been weak. That's been the story for the last few months. The U.S. picture, while we are in the driving season, that could boost demand a bit. But fundamentally, if this trade war drags on, we have to look at what happens domestically in the United States. The economic situation there might also be challenging. You might not see a large increase in oil demand there. And then you have OPEC Plus continuing to add barrels into the market. Over the last few months, they've been agreeing to increase output more than normal. They might continue that. And then also just looking at Iran, Iran's been shipping more as well, likely because of, to get ahead of any sort of disruption. They've been increasing their exports, but that's also adding barrels to the market. So you're in a situation where you have a lot of supply coming in. Maybe you'll have even shale drillers taking advantage of the recent price spike, and that could add a little bit of supply as well. Overall, you're in a situation where the oil market is a lot frothier, and that's going to put some downward pressure on prices. So yeah, I think where we are in the $60 range is likely to be where the market stays, as opposed to 70, 80, or what we were saying earlier, $130 if the Strait of Hormuz, which would shut, and that doesn't look likely at all.
Fantastic context. As always, Stephen Slapczynski with his insights there, certainly, and focus on the fundamentals as far as the oil market is concerned, and also on the latest on Iran and Israel. Jill Deese is there, of course, our news desk editor in the Hong Kong studios for us. Coming up here, and we'll leave you with a live look. We'll take a short break, but before we head to that, a live look at Tel Aviv right now in the early hours of the morning this Tuesday, and of course the uncertainty around that ceasefire announced by President Trump a few hours back. And of course, at those times on your screens, Neil Beveridge will be talking about oil markets. The markets are operating on two figures right now. What is the high and the spike, and what is the long-term average on the settle? We'll get his take on both those figures coming up at 9:30 Hong Kong time at about the open. That's plenty more ahead. This is The China Show. Morning, welcome back. You're watching The China Show. 14 minutes ahead of the opening bell, and investors are adding slightly more risk this morning given the news flow coming through out of the Middle East. Lots of uncertainty still, but they're, Yvonne, incrementally enough here at least to push risk assets higher, a third of 1%. We're now at 2-week highs, more specifically on A50 futures.
Yeah, stocks are up. Oil is down. Certainly, risk assets are doing a lot better in the last couple of days, today compared to the last couple of days, I should say. But really, on the agenda today in China is what's happening in Tianjin, right? The World Economic Forum's annual gathering in China is getting underway today. The meeting of the new champions, as it's officially called, is perhaps better known as a summer Davos. Let's bring in our chief North Asia correspondent, Stephen Ingles. He is at the event in Tianjin and joins us now. Steve.
Hey, Yvonne, I like to hearken to that note you forwarded around yesterday about from Morgan Stanley that talks about the 3D challenges, right? Debt, deflation, demographics. But I think it's a 5D challenge because you can add Donald Trump and now what's happening in the Middle East, diplomacy as well to that. Let's bring in our next guest is Jianguang Shen, JD.com vice president and also chief economist. You've also worked at the ECB, you've worked at the IMF. You have a good sense of what is happening to the Chinese economy and the external shocks as well. Thanks for joining us here at the World Economic Forum in Tianjin. First, I want to get your take on this off-ramp that we've seen in the tensions in the Middle East. Obviously, China has great influence in Tehran, also great importance because of the oil that it does import from the Middle East, in particular from Iran. How encouraged are you by the de-escalation of tensions?
Oh, definitely, that's a good news. The escalation, and we are also seeing the oil price has declined, and this calm down. It's a very important energy source for China. So definitely, it's a good news.
So an oil shock would have been pretty difficult for a struggling Chinese economy to cope with, or would you say because their energy transition has moved away from being completely dependent on oil, or would that oil shock, if things had gotten more intensified, be very difficult for a recovering Chinese economy?
Yeah, oil definitely is still a very important energy source, but we are also seeing this new energy revolution in China. You see all this wind power, solar panel, all this development in China. So definitely still China cannot walk away from the oil, right? So still very important energy source, but that's actually we are seeing the new tech, all this new technology about energy sources. That's actually China is moving very fast. We are already seeing China is the most important exporters of this green energy products right now.
So the external shocks are obviously critical to your business at JD.com, but also because the other half of the coin is boosting domestic consumption. And I think JD.com has essentially done a quite large purchase of products that are going to be normally earmarked for export. You're going to sell it into the domestic market as well, right? How important, what's the priority for boosting domestic consumption? There's been fits and starts to boost domestic consumption.
Oh, definitely. For us, the most important market is still China. We are importing all kinds of goods from globally, to China. So the Chinese market definitely is now account for 90% of our revenue. So actually we are seeing a quite positive news is the government start to shift away from investment, centric strategy. Now actually I can even go far to say that it's not look like it's a consumption-centric policy. It's under formation in China. So the government earmarked 300 billion renminbi for trading policy, so that they subsidized 20% of the goods like iPhones sold in China.
But what happens when those subsidies and the trade-in program runs out of steam? I mean, this economy is still very reluctant, and the households are still very reluctant to spend. There was a great quote you said recently: if China wants to wrestle with the United States, it also needs to strengthen its own domestic demand.
Definitely.
How is that going to happen? Because despite, I know, yes, there's been short month-on-month increases because of the trade-in program, but long-term, how are you going to make this more sustainable?
Yeah, of course, 300 billion renminbi, this consumption subsidy, that's only just a short-term stimulus. It cannot continue forever. But I have to say, they probably will continue for the next 2 to 3 years, right? That's actually, help a lot. Like maybe after 300 billion, I believe there'll be more increase, probably to 400 billion to 500 billion. So, of course, that's just a stimulus, right? It's a short-term stimulus. We all know that. But longer term, definitely China need to do much more to, for example, regarding this income policy. The rural income policy is much more important. Like a rural, pension system.
Right.
So there's a much lower pension for the elderly people in the rural area.
What is the trade war doing for JD.com's external ambitions? You told me before this interview that you're doing pretty well in Europe, warehouses and the like. Has this set back? Does the trade war, it's a truce right now, but there's lasting differences between China and the United States and also issues with Europe as well. How is that impacting JD.com's international efforts?
Yeah, so far, actually, I think that this actually has stimulated, actually make us more determined to invest abroad and to move to Europe, to other countries. For example, our chairman, he is actually co-chairman of this forum.
And he's here this week.
Yes. And actually, he said very clearly, he believed this cross-border, e-commerce, the model, JD's model, actually is more promising. It's not like like small parcels. You can ship to Europe, to America, without paying any tariffs. But we are paying tariffs. So we actually building our whole infrastructure in Europe. We also have our warehouses. We also hire already 2,000 delivery workers in Europe. So to boost the local employment and actually build using our state-of-art warehouse automation technology in Europe, in other countries we are going there. And we export all the goods in our airplane, truckloads. We are not avoiding any tariff payment. So that actually to us is a more opportunity if things have changed in this way and our model become more have more advantage.
Jianguang, thanks so much for your time on Bloomberg Television. We could spend the whole half hour, the whole hour talking about these things. Thanks so much for your time. Sure. All right, Yvonne, David, back to you from Tianjin.
Fantastic. Steve there, of course, with the Vice President and Chief Economist at JD.com, Shen Jianguang. As they were just having a conversation there, the renminbi midpoint of the day is out. Interesting here. So two things. It's the strongest fix going back to November, but the market may have gotten ahead of itself here as far as adjusting to the recent strong fixings coming through here out of the PBOC. So that while the fixing was strong, it was on the weaker side of the median estimates on your screens right now. Dollar China flat 717.24. We're looking at gains going into the open today. 6 minutes away, you're watching The China Show. Welcome back. It's looking like we are going into a higher open today equity market-wise. Across sectors, everything but oil-related stocks are on the way up, Yvonne.
Yep, and you continue to see that here right now when it comes to oil. Obviously, we have seen that whiplash when it comes to oil prices in the last 48, 72 hours, and they are actually following the price of crude lower here this morning. PetroChina down and CNOOC down close to 3%. And Shanghai crude, there you go, free falling some 9% here this morning. We got the open coming up next.
It's nearly 4:30 in the morning in Tel Aviv as we wake up to the likelihood of a ceasefire, and certainly most of the news flow so far does suggest we are headed in that direction. One potential complication, though, and we'll see how this evolves, Yvonne, certainly, is the commentary coming from the Iranians earlier on that there has been no agreement, but largely will depend whether Israel stops its military action there, which, as we've reported in the last hour or so, is continuing, of course, in parts of Tehran. We'll see what happens, of course, going into the ceasefire in a couple of hours or so. Yvonne.
Yep, and we've been hearing that President Trump has spoken directly to Benjamin Netanyahu. Not sure what came out of that call, but yes, as Jill Deeses, our editor, mentioned, right, we're still waiting for Israel's response to all this and whether they are really on board with this ceasefire. So certainly that's one thing to watch. But it seems like the market right now is just going with it. The fact that this potential ceasefire is going to be starting in just a few hours, midnight D.C. time. So certainly that's one thing to watch. The initial response really has been sell oil, sell the dollar, buy stocks over overall, basically. You take a look at how onshore markets are doing. We are seeing slight upside here, and we're watching very closely Shanghai crude, right? 9% drop there in the last couple of minutes. So certainly we are following the price of Brent, following the price of WTI overnight here. And just given what we've been seeing, right, we basically, it seems like all the concerns about a big supply shock are put behind us. Maybe now is what the narrative is, right? The worst might be behind us here right now. Key question, though, how much lower can we see these oil prices go, given the fact that, as Steve Stapczynski mentioned, right, we're going to head back to this whole supply-demand dynamics pretty soon, and we're going to focus that attention back to that, hopefully. Take a look when it comes to how stocks are doing, though. Yeah, mostly we're seeing CATL shares are up some at 1% as well. Medea Group's doing quite well. Right now we're not seeing a whole lot of movement when it comes to the bond market, but we'll watch that fix, right? So as Dave mentioned, it was weaker than expected, but still one of the strongest fixes from the PBOC since November. So we're still seeing that the PBOC is still leaning towards that strength. Maybe the traders or maybe the analysts out there just got ahead of themselves, as David mentioned. Hong Kong's looking like this here right now. We focus, of course, on the oil sort of plays, the defense plays, which were all pretty much rallying yesterday. Right now, Hong Kong doing much better. And we are seeing, once again, potentially those southbound flows resuming. We're up about 1% on HS Tech as well as the Hang Seng here right now. And we're watching very closely Hong Kong dollar, right? 784.99. So once again, still leaning towards that weaker side of the trading band, and we're pretty flat on the currency of renminbi, 717 right now. But stocks, especially tech, is doing quite well. There were some reports of Alibaba. They might be merging the delivery and travel units. Citi's saying that's a pretty good thing for the stock overall. Oil stocks are doing this year right now, all falling with the price of oil. China oil field services in particular falling the most, around 5%. But it's quite interesting, right? This whole fading oil's rallies. Given some of these geopolitical events in the past, Dave, it's quite telling. This has actually been a pretty good strategy for many oil traders out there. You compare, key events like Russia, Ukraine, Hamas attacks in Israel, some of the strikes from Iran and Israel. Pretty much, I think, barring the Ukraine war, for the most part, things actually start heading lower, and actually fading these oil rallies on the back of this geopolitical risk might actually be working out. So does that mean this time around we might actually see the same? Possibly, right? Because, yes, we already see news of a ceasefire, and maybe what proceeds from all of that is still an OPEC plus that continues to increase output. So underlying all that right now, potentially we could be hitting $60 oil. If not, the question of the day today, could we actually be hitting $50 oil too, Dave? Certainly up for a question there right now.
Yeah. How quickly we've gone from talking about, is it 150 or 50? And certainly, clearly those are extreme scenarios, but you're right. The point that Stephen Stapczynski was making, of course, overseas our oil coverage, Asia Pacific, was, if you lift the curtain and pull it back, what you really see fundamentally in many of those instances is really a fundamentally weak oil market. So certainly fading the spike is a rat. In fact, when you have a look at that specific story that's on the terminal for our Bloomberg clients, if you can read all about that, the details there and the commentary, a successful oil trading strategy, as Yvonne is pointing out, sell the spikes. Yvonne.
Yep, let's see if that's the case there. And get the take from Neil Beveridge, APAC Director of Equity Research at AB Bernstein. It seems like markets are really pricing in that this is over, this whole conflict. Do you think that's justified?
Yeah, that's right. It's one of the biggest drops we've seen in Brent in history. But yeah, I think, if you look at where we were before this whole crisis began, Brent was around $60, $65. We've seen it increase to close to $80, and we're back to, just under $70, again. So, a lot of the risk premium really, come out of the market.
And where does that leave, fundamentals now, right? Is it time to really shift back to this market that seems to be oversupplied? Yeah.
If you look at the fundamentals, there was a very weak demand picture really for 2025. What we've seen is slowing Chinese consumption. The golden age of Chinese oil demand, as we've been saying for some time, is over. If you look at non-OPEC supply growth, it's comfortably over 1 million barrels a day, so really outrunning demand. And then on top of that, we've got the unwinding of the 2 million barrels a day of OPEC cuts, and those have been accelerated in the market. So there's no physical shortage of oil in the market right now. We didn't see any disruption to Iranian oil flows during this entire event. We've actually seen more oil coming out of the Middle East. So oil markets from a physical standpoint are well supplied. So, I think we'd easily see Brent fall down to the $60, $65 barrel range again.
Neil, David here, can we make also just more granular, I guess, there on the point you just made, can we make the same assumption specifically on Iran? Iran oil exports, business as usual, question mark?
Well, I think a lot will depend upon what's agreed as part of any ceasefire. Whether or not we see the U.S. relax some of the sanctions around Iranian oil exports. We saw, of course, the U.S. Ratchet up some of the sanctions around secondary buying of Iranian oil. But so far, Iranian exports have really held in around 2 million barrels a day. We really haven't seen any signs of a significant downturn in that. And if there is a positive agreement between the U.S. and Iran, maybe you see Iranian oil exports actually tick up a little bit from here.
Neil, so would you recommend paring back most, if not all, hedges at this point?
Well, I think that what's interesting about, certainly when we look at the oil equity market, so I think, you've got to look at the distinction between physical oil markets and what's happening around equities. So, certainly I think on fundamentals there's more downside in crude. But if you actually look at a lot of the equities, which are, selling off a bit today, a lot of the equities really haven't seen a significant move over the last month. And that's because I think equity markets have said, well, first of all, the risk of any disruption through the Straits of Hormuz, may be a relatively low probability. But secondly, even if it happens, even if we get a price spike in the short term, it really doesn't impact the long-term, valuation of these stocks, which are based upon, long-term prices, of around $70 a barrel. And if you look at the long end of the forward curve, even throughout this entire event, it stayed almost flat. So all the price action's really been at the front end of the forward curve. The back end of the forward curve, which really matters from an equity valuation standpoint, hasn't really moved. And we would argue that, certainly if you look at marginal costs of supply, it's still around $70 a barrel. The US needs, I think, around $60 a barrel to grow. And so even if we see Brent prices in the front month pull back to 60, 65, I don't think we'll see a significant downside, to oil equities, which I would say haven't really moved that much since the start of the crisis.
Who do you think is most, I guess, vulnerable to potential disruptions to oil imports, for example? I mean, China, obviously, we've been talking about, they supply or they import a lot of Iranian oil, but then it seems like they've also kept up with oil reserves as well. Like, in this region, who's most at risk?
Yeah, so, China is the biggest oil importer in the world, imports 12 million barrels a day. India is the second largest, importing 4 to 5 million barrels a day. If you look at it as a percentage of GDP, you could say India is the most exposed. China, in terms of physical imports the most. But I think, the key lesson for China in all of this, and you can see it very clearly in China's energy strategy, is the shift towards electricity. So China's doing everything it can to shift, ICE vehicles onto EVs, diesel trucks onto electric trucks, fuel oil ships onto, electric ships, people onto high-speed rail rather than, jet-fueled, aircraft. And so I think for China's energy security, this has really been a wake-up call. And just a reminder that the biggest weakness that China has is dependence on imports of oil from the Middle East. And I think this is going to accelerate their shift onto, power over oil.
Neil, and I suspect the next chapter on that specific story, and we're already seeing it with BYD, for example, putting up, of course, some production hubs in Eastern Europe, is that electrification story that caught a lot of people off guard domestically in China. They're exporting that story to very varied parts of the world. Do you think, how does that change effectively the energy strategy and mix and long-term oil demand in those specific markets where China's exporting those EVs to?
Yeah, well, China is electrifying its energy mix faster than any other country. And, at the moment, about 30% of China's final energy demand is power. That's going to rise to about 50%. As China really, starts to export, clean energy technology, electric vehicles, it will start to have an impact on other economies that will also, shift towards, electricity. But what we're seeing is, with, the combination of, clean energy plus, AI, this electrification megatrend, is really, gathering pace, I would say, within the market. If you look at some of the best performing, energy stocks in the region this year, they've largely been related to, power grid, utilities, and some of the nuclear names, which have been the biggest beneficiaries.
Neil, we've got to leave it there, but thank you so much. Neil Beveridge there, APAC Director of Equity Research at AB Bernstein. We got plenty more ahead. This is Bloomberg. Let's head back to the World Economic Forum in Tianjin, and our very own Stephen Ingles is there with our next guest. Take it away, Steve.
Yeah, we're talking about everything to do with the global economy here at the World Economic Forum. Summer Davos in Tianjin this year in the largest convention center I have actually ever seen in my life. Brand new in Tianjin. Looks kind of like a hangar from Star Wars and the Imperial Star Cruiser, but I digress. It's huge, trust me here. Let's bring in our next guest. So good to see you again. Nonkululeko Nyembezi.
Well done.
Thank you so much.
Thank you for having me.
Thanks so much. She is the chair of Standard Bank Group of South Africa, South Africa's largest financial institution by assets. Thanks so much for joining us again. So obviously there are a lot of stresses in the world right now, amplified by what happened in the Middle East over the last 72 hours or so. It comes on the heels of what the South African Central Bank, the SARB, essentially came out with their, I believe it's a quarterly report saying growing geopolitical upheaval, global policy uncertainty are the biggest risks facing South Africa's financial industry. I would assume you would agree that what's happening externally right now is probably the biggest stress to you, the financial situation in Africa.
Absolutely correct. And thank you very much for this meeting. Essentially, we can deal with bad policy because we know what we're dealing with. We prefer good policy, of course, but bad policy is something you can deal with. Uncertainty is the issue. So if you wake up from the one day to the next and you're not quite sure how to pivot your strategies and your implementation plans, that is actually something that we don't know how to do. It is particularly the case in a continent like Africa, and especially a country like South Africa, that's very open to the rest of the world. We are very much plugged into the global economy, neither really looking east nor west, but dealing with both. So you're absolutely right, the uncertainty is at the moment at a level that is hard to cope with.
On top of what's happening in and around the Straits of Hormuz to the north of the African continent, you also have the threat of tariffs. South Africa was slapped, at least on Liberation Day, with 31%, one of the highest, obviously. And the United States is the second biggest trading partner with South Africa after, of course, China's big presence. So where does that add to the risk if after this pause expires, we go into an ultra tariff, high tariff environment? How does South Africa, from your vantage point, from the banking industry, also the metals industry, how do you help mitigate that?
Yeah. So if we look at perhaps a more granular look, because it's hard to talk about tariffs broadly across the continent. If we just look at South Africa on its own, as a total percentage of GDP, actually the number is not large. We would estimate that the total impact of the loss of tariff-free access to the American market would probably be about a 10 or so basis points hit on our GDP, at most 20. However, you take one level down and you say, well, it is actually concentrated in certain sectors, the first being the auto sector, and that is a huge, huge impact on jobs in particular and jobs in manufacturing. So that will hurt and will hurt very much in that. The second one is agriculture. There is a vast amount of agricultural output. Just think of the wine, for example, that goes to the US, and that would also be particularly hit. Is that a permanent or terminal issue? I guess it would not be, especially on the agriculture side, but it takes time to really just grow other markets into which to apply your product. And of course, everybody else is doing the same thing because everybody else is hurt by those tariffs. So from a South Africa Inc. perspective, we are hurt, but not terminally so. You then just go further north to Lesotho, for example, which was slapped with a 50% tariff on their textile industry. That is a huge, huge impact, negatively, more than 50% of their foreign earnings, in fact, probably 75%. So we go country by country to understand the impact and therefore how we might react to that.
So how do you see the relationship then in the face of the tariffs from the United States, relationship with China growing? I believe China has just added another 7 or so African nations for tariff-free trade with China. I know we're here potentially signing that CIPS agreement for clearing in renminbi. That's another interesting development for other banks around the world, signing on to the equivalent to the U.S. SWIFT clearing system. And then, of course, the rare earths is a great opportunity for other nations to come in and sort of counter what China has as a stranglehold on those rare earths. It's a huge question, but it's a great opportunity, but also a challenge for African nations.
Okay, well, if I forget any of that, you must remind me, but let me start where you ended. So rare earths essentially, let me say critical minerals broadly, because rare earths is a small part of it. And actually, they're not as rare as the name suggests. But anyway, Africa is host to more than 50%. I'm going to say round numbers, between 30 and 70%, depending which metal or mineral you're talking about, but is a host to a huge percentage of what is available in the globe. A lot of it still requiring prospecting rather than actually extraction. And so if the decisions we make now and the steps we take are right, this could be a once-in-a-generation opportunity for the African continent to essentially leapfrog its industrial capacity from where it is now to a new era for broader economic growth and development. So how we play this whole business of don't just extract, throw in a ship and sell, but add value at even a minimal processing level, we really could see a huge benefit for the continent. Everybody realizes this, of course. The question you would ask is, why is it not happening?
Yeah, I mean, there have been false promises before, false dawns.
It's energy. It is because until you have plentiful, accessible, affordable energy for processing, those things cannot happen. So if you look at where processing of critical minerals and rare earths happens today, whether be it simple or complex, it happens in China. And so China invested first and foremost in their energy infrastructure. So the realization, and of course at the moment also helped by the World Bank's programs pushing in that direction, but the realization that it all starts with your energy infrastructure has dawned, and I think African governments are doing something real about it.
So you have a unique position because, of course, you are the chair of the largest bank in Africa by assets in South Africa, but you're also on the board of Anglo-American. You were the former CEO of ArcelorMittal. You know the two industries, finance and resources. So are the money flows flowing in the right direction to realize this dream of the African continent to provide the critical minerals and not just have a constant supply to China? It could be an alternative.
I would say the penny dropped a while ago. The distance between penny dropping and something happening can be quite large because it's not only a private sector issue, you also have governments coming into it, making sure that the regulatory framework, for example, is right, making sure that the country opens itself to FDI and capital flows from outside, because certainly there is not sufficient capital in the continent itself to do all of these things that are capable of happening. It's happening, but it's happening in spots. You hear this country, for example, say, we will no longer allow the export of raw, unprocessed minerals. We want some processing here. You've heard it happen, for example, in Zimbabwe with their lithium. So I would say to you that it is happening. We're always very, very hasty. We want it to happen yesterday. It will take time. But if I just go back now to the China issue, because I think China is such a pivotal part of this. You mentioned CIPS, and CIPS will help in a great deal of the markets that we service, because essentially they no longer have to go out looking for dollars. They can pay in RMB. and we can facilitate those payments in RMB. As you know, we have been working with Chinese companies for a very long time. We have some large companies in the African continent that will benefit from that. That's part of what needs to happen to make all of this happen.
Ms. Nyembezi, thanks so much for your time. I wish we could spend a lot more time on that. You signed that agreement last week, I believe, in Shanghai for CIPS, the Chinese alternative to the SWIFT clearing system from the United States. Okay, sending it back to you. Much more coming from Tianjin at the World Economic Forum Summer Davos.
All right, Steve, fantastic. There will be with Steve a bit later on in the show. We will leave you with a look at energy markets right now as we head into this break, and more, of course, on this developing story on Iran and Israel. Plenty more ahead. This is the China Show.
All right, we're still waiting for some sort of confirmation on both sides on this potential ceasefire between U.S., Iran, and Israel, but we'll continue to follow the latest there, bringing you the latest coming up. Welcome back to the China Show. Here's a look at the HSI half hour into the session. And yes, we continue to see stocks edging higher here this morning around those session highs. And really, we've been tracking this potential ceasefire between the U.S. and Iran. And that certainly has led to a big reprieve across risk assets here this morning. So stocks are up, dollar is on offer, oil prices continue to plunge. And we're holding on to those losses here this morning, Dave. But still, as we speak, right, we're still waiting for that official confirmation, especially from the Israeli side of things.
Yeah, and I think that's going to be key here, right? So we know what, based on what President Trump said, we know, of course, that he had the conversation directly with Bibi Netanyahu. Separately, of course, the conversation we had in the post we had coming through out of the Iranians talking about how there had been no agreement, but a lot of it is contingent on what Israel does. If they don't do anything further, then that's it. With the passage of time, and it's certainly to the point you're making, markets seem to be trading on the assumption that with the passage of time, we are headed into a de-escalation of sorts. You look at oil markets price itself, we talked about this, right? Backwardation, the spread, we've gone from 170, 180 back to below $1 on that prompt spread. So it does indicate, and we'll see, right? We'll see whether or not this pause and this permanent ceasefire in many ways holds, and hopefully we are headed there, Yvonne.
Yeah, and we mentioned, right, the oil price is certainly quite telling, right? We basically have retraced all of the gains that we saw from the moment that this conflict began 12 days ago, right? So, the fact is that I guess the traders were not willing to really put that high of a war premium in the initial get-going because of the underlying fundamentals overall, that this is still a market that is going to be quite oversupplied and possibly even, demand is not going to be looking too good in the second half. So there you go. That's why we're seeing the last 2 days, Brent markets have basically plunged some 10%, just given this relief that we're seeing on the geopolitics side of things here as well. So certainly markets are certainly liking the news so far. Of course, we're still waiting for, some of the details. I mean, obviously the ceasefire doesn't begin for another an hour or two. So certainly we'll watch that. And also any sort of confirmation from authorities from all sides. Let's bring in Cameron Systermans, head of multi-asset for Asia and Japan at Mercer. It seems like markets are just going with it, that right now, all any sort of, a supply shock to oil, is that sort of something we could just push aside now?
Yeah, I think it's too early to be confident of what might happen here. It's always incredibly difficult to guess what's going to happen with geopolitics, but I think that's what the markets have more or less priced in. So we're back now with oil prices to where they were a few weeks ago before the current sort of tensions kicked off. And as you say, I mean, I think a lot of the premium has been taken out here. But, I mean, take it beyond the oil market. I think our view is that to the extent that there isn't an oil price shock, that it doesn't really change the broader picture for where we see the global economy going, inflation, and, of course, the equity markets. And so potentially, I mean, this brings the focus back to what's happening with tariffs going forward. I mean, we're only 2 weeks away from the end of the 90-day pause on all countries ex-China.
And you've been saying that, the negative impact from tariffs is something that the markets seem to be overlooking in some ways. What do you think that they're missing in particular?
Yeah, certainly. I mean, since the April 2 announcement of the reciprocal tariffs, which, as we know, are paused, and there's been a number of exemptions and a bit of toing and froing, court challenges, all sorts of things happening since then. But equity markets are up, 7% or so since those initial announcements. But we still don't really have clarity on where the tariffs are going. Sort of best estimates, or at the start of this year, the effective tariff rate across the US economy was about 3%, which is quite low. And based on what the most likely scenario from here, they might head up to about 15%, which is a substantial shock and would bring tariffs up to the highest since the 1940s. And economists estimate that that's going to take something like 1 to 1.5 percentage points off GDP growth, which doesn't appear to be priced into the markets.
Cameron, David here. So begs a very simple question. Why are equity markets up?
Yeah, it's a great question, David, and it's something that we've been trying to get our head across as well. I think if you look at some of the flow data, it does look like there has been some reasonably strong buying, particularly from some of the sort of retail investors. But maybe it's just a case of uncertainty in that nobody really knows what's going to happen here. And so maybe a lot of investors have been brushing that aside. I guess in the last US earnings season, that a lot of companies, again, they didn't really have a strong picture on where this was going. So rather than adjusting their guidance downwards, they've left a lot of guidance unchanged, which is maybe what the markets might be taking their cue from.
So what are you overweight and why?
Yeah, so right now we are underweight equities, as we do believe that the markets are underpricing the tariffs, as I mentioned. Forward earnings growth in the US over the next year is still forecast to be positive, which, in the context of the downside surprises to growth that we are expecting, does seem a little bit too positive. At the same time, valuations remain expensive, and as I mentioned, that there has been quite a bit of buying recently, so that's unfavourable for equities. Our preferred offset to equities, so overweight now, is actually cash. So in dollar cash, you're still earning 4%. I guess the alternative here might be to using government bonds, but I guess yields are neither here nor there. They're not really at levels that you would say are attractive just yet, but they're also not expensive either. So if there were to be an increase in yields, if maybe US 10-year treasuries were to come closer to testing that 5% level, we might be more interested in buying. But at this point in time, cash does seem to be the best offset for an underweight to equities.
And you say that this is one of the more common questions that you're getting from clients, is whether treasuries are that sort of risk-free sort of haven. What is the answer to that? If you take a short-term view and a long-term view, does it differ?
Yeah, I mean, I think that US Treasury is always going to retain their haven status, right? You're looking at bonds issued by a highly rated, although there have been some downgrades, they're highly rated, developed market economy that can issue debt in its own currency. And if potentially foreign investors become less interested in US Treasuries, I think there will still be a strong bid from domestic investors in the US. Think of your insurance companies, your pensions and so on, they would be more than happy to buy at higher levels. And so maybe if there is reduced demand from foreign investors, that the mechanism there is actually a weaker dollar as opposed to a surge in Treasury yields.
So what are you doing in terms of duration right now?
So duration right now, in terms of global or US duration, we're broadly in line with our benchmarks. Although we do have some long duration exposure through UK gilts, which we think are undervalued. Markets are a little bit too pessimistic about the ability of the Bank of England to bring inflation back down, and which is not really what we're seeing in the labour markets are loosening, and we expect that to flow through into lower inflation. And obviously, there's a lot of growth challenges for the UK for the long term.
Cameron, just need to ask you, one of your overweights too here I can see is Frontier market debt. So I guess that doesn't seem to, jive with your earlier point and might not have anything to do with that. The defensive nature of your underweight in global equities. Tell us why that specific part of the fixed income market, which I guess, as I alluded to, isn't exactly risk-free.
Yeah, that's a great question, David. And somewhat counterintuitively, we would say that in frontier market debt, which is the sovereign debt issued by relatively less developed or lower rated sovereigns, so some of that in their local currency, some in US dollars, is actually less risky than the more traditional emerging market debt, be that your hard currency or local currency. And the reasons for that largely come down to lower participation of a lot of foreign investors in the frontier markets. And so as a result of that, you don't tend to get the same hot money inflows and outflows that lead to a higher correlation with other risk assets in the market. So there's a greater degree of idiosyncratic drivers. And at the same time, I think a lot of these frontier markets still have quite high real yields and also high nominal yields. It's a lot lower that they can come down to. And generally reasonable fiscal dynamics as well.
Cameron, thank you so much for taking the time to speak with us today. Cameron Systermans, the head of Multi-Assets Asia and Japan, of course, at Mercer. Right, let's take it back to the top story today and developments, the latest in the context here with Israel and Iran. Let's head it over now, of course, and bring in our colleague and co-anchor, Horizons Middle East and Africa co-anchor Jomana Bersetchi, joining us out of Dubai. It's been incredibly busy for you. I've been following everything that you've done on social media, what you've done across different platforms right now. Jomana, help us understand this. Markets seem to be trading as if this is over. What's the context here? Is it over?
Context is this was a remarkable 24 hours in the region. If you just rewind back to this time yesterday, we were talking about the potential Iran retaliation to those U.S. strikes on the nuclear facilities over the weekend. In the evening, we got that retaliation, Iran firing missiles towards that Al Udeid base in Qatar, all intercepted, no fatalities recorded. And then overnight, people in the region are now beginning to wake up to news to a potential ceasefire. So this is in reference to that post that President Trump put out just a couple of hours ago, suggesting that a ceasefire agreement had been signed to from both parties, from both Israel and Iran. Now, the thing is, we don't have a lot of details at this point. Israel have so far not commented on whether the ceasefire is going ahead, but what we do have is a couple of tweets put out by the Iranian Foreign Minister Abbas Araghchi. He said that provided that the Israeli regime stop their quote-unquote illegal aggression no later than 4 a.m., we have no intention to continue our response afterwards. And shortly after that, he said that the military operations continued until the very last minute. So we can read that as, from the Iranian perspective, at least they plan to honor the ceasefire, still waiting for a comment from Israel. So a remarkable turnaround in terms of events. President Trump is calling this the 12-day war that perhaps is a nod to the 6-day war that took place in 1967. Between Israel and Arab countries. Whether or not this is going to lead to an enduring, lasting ceasefire, big question. The other big question, of course, is whether this actually permanently sets back or derails Iran's plans to go on and build a nuclear weapon. So still a lot of question marks, but definitely most people in this region are waking up to the news and breathing a sigh of relief that things didn't get worse.
Yeah, Jomana, as you speak, we did hear from the Israeli Defense Forces now. So IDF is now identifying missiles launched from Iran a short while ago, and they posted on Telegram about intercepting that threat. So we still see military action happening at this hour. Walk us through what the outstanding issues still are at this point.
Yeah, so as you say, it appears as though there were strikes and counterstrikes until the very last minute. So that 4 a.m. Tehran time already passed about an hour ago. Technically, the ceasefire is supposed to come into play in a couple of hours' time. So 8 a.m. Dubai time, that's roughly 2 hours from now. We'll see whether both sides respect it. And I'm being cautious, again, because we're waiting for that full comment from the Israeli perspective. And as you say, IDF were reporting missiles still being launched towards Israel. But in terms of the outstanding issues, just to go back, number one, what does this mean for Iran's nuclear ambitions? Remember, there's still the matter of that hidden stockpile, the highly enriched uranium. IAEA are saying essentially they don't know where it is. The Iranians said that they had moved that secret stockpile before U.S. launched the attacks over the weekend. So they're still sitting on highly enriched material. What they decide to do from here is going to be a big question. Second point is whether this ceasefire actually encourages the diplomatic channels to once again be worked. Will Iran come back to the negotiating table? Will they be willing to compromise even further and allow for concessions that they weren't going to allow for prior to this quote-unquote 12-day war? And thirdly, what does it mean for Israel and their own war objectives? Because so far what they have said is they wanted to eliminate Iran's ability to fire ballistic missiles, to eliminate their ability to produce a nuclear weapon. And if the consequence of that is a potential regime change, of course, Israel would favor that. It hasn't been an explicit goal per se. Is enough done? Will Israel have deemed that enough actions have been taken in the last 12 days for them to deem this war a success? That is also another big question.
Jumana, thank you so much for joining us. Jumana Bershechi there, joining us from Dubai. Of course, you can watch Jumana on Horizons Middle East and Africa in just about 2 hours' time with the Israeli-Iran ceasefire set to take effect once her show starts. All right, we're going to leave you with a live shot of Tel Aviv amid this uncertainty over the ceasefire announced by President Trump just a few hours back. More ahead. This is Bloomberg.
Here are some corporate stories that we're tracking at this point in time. Let's start things off with Virgin. Australia has, well, the company has resumed trading in Sydney after raising $444 million here in one of the country's biggest share sales in years. Now, Bain Capital remains the airline's biggest shareholder, while Qatar Airways will also keep its substantial holding in the company. Virgin Australia was previously publicly traded before collapsing in the early days of the pandemic. Now, state-owned firms Beijing Capital, China State Construction Engineering, and Guangdong Holdings are said to be among bidders for Suez's water assets in China. Sources tell us that the three firms have been shortlisted and that BlackRock-backed Suez may actually seek a valuation here of more than $2 billion for its Chinese assets. Now, it has more than 40 contracts, 40, with local authorities and companies in China.
Well, Starbucks is disputing a report that is thinking of selling its China business. Caixin Global reported that the company held talks with over a dozen potential partners, including private equity firms Hillhouse and Fountain Vest. But Starbucks not saying it's not considering a full sale. The brand has struggled in China due to weak consumption and local competition. All right, just weeks ago, after Huawei released its latest computer product, the results are in. And it seems that the company's progress on chip technology has stalled. Now, that's according to a teardown of the product by consultancy firm Tech Insights. Let's get more now with our tech reporter, Annabelle Jewelers, and what do they find in this whole teardown?
Yeah, so Tech Insights, it's a consultancy based in Canada, and they've done these teardowns in the past where they essentially strip back all of the technology, check exactly what's inside. So we're talking about the MateBook Fold here. It's a laptop and a tablet in one. It was released back in May of this year, and there were rumours at the time at the product release that maybe it could involve some breakthrough technology from SMIC, which is their chip partner essentially in this fabrication process, that it could involve the 5nm equivalent. So you're talking about N+3. But at Tech Insights, they did this breakdown, and what they found is that the MateBook Fold is actually built using N+2. So not N+3, N+2, and that's a 7nm process node. So it tells you that, okay, 7nm process node, that's the technology they were using back in August of 2023, which means that it hasn't really changed since they had the big breakthrough with the Huawei Mate smartphone. So yeah, again, like the 5nm process, it's still elusive, and maybe it just tells us SMIC hasn't figured out how to make this at scale yet.
And despite what the Huawei founder and chairman has said about, dismissing the impact from these U.S. tech curbs, it is a telling sign that maybe they are actually working in some ways on China.
Absolutely. I mean, both SMIC and Huawei, they face U.S. sanctions across a range of different ways, whether it's the entity list, whether they're getting access or restricted access to equipment and technology through export controls. They really do face a lot of challenges, and it puts SMIC in a really difficult position when it's trying to play catch-up to established foundry leaders. I mean, one of the big areas, for instance, is EUV machines. That's extreme ultraviolet lithography. geography, and that really prevents them from getting down to a small level. Still, what is notable about this MacBook Fold is that it did actually involve their own operating system for the first time. That's the Harmony one. That's the challenger to Microsoft. And so they are really trying to build out that full computing stack. But at the chip fabrication level, just to reiterate here, if Huawei is really stuck on that 7-nanometer equivalent, it tells you that it's now getting multiple generations behind the likes of Apple, AMD, Qualcomm, but you have the likes of TSMC, for instance, Samsung, Intel, even Rapidus. All of them are pledging to make that 2-nanometer process available to customers in the next 12 to 24 months.
Belle, thank you. Annabelle Jewelers there on that, the latest there on that specific story. Okay, some breaking news coming through. U.S. President Trump's Truth Social post. Some headlines are coming through. I'll just read through the actual post just in case you guys don't have access to it. So Israel and Iran, he says, came to me almost simultaneously and said, peace. I knew the time was now. The world and the Middle East are the real winners. Both nations will see tremendous love, peace, and prosperity in their futures. They have so much to gain and yet so much to lose if they stray from the road of righteousness and truth. The future for both countries is unlimited and filled with great promise. God bless you both. That's the context. And of course, we're counting down to the ceasefire when that takes place roughly in about just over 90 minutes from now. And you know what? If they do manage to land this thing, that's going to be quite an achievement, of course, if that is, of course, what lies on the other side of the next few hours or so out of the President Trump. There we go. Plenty more ahead. This is The China Show. Welcome back. We'll take you straight back here to the breaking news, Yvonne, that we just had out of the U.S. President Truth Social post. Rather lengthy one, but suffice to say, I think the message there was both Iran and Israel came to him almost simultaneously, and he is encouraged over what the future holds, given if both sides, of course, stick to what they apparently talked about there, Yvonne.
Yeah, if Iran holds, right, and sticks with this ceasefire, as you mentioned, right, what can we call? I mean, is this really going to be a big foreign policy success, really, for President Trump, right, who basically in 12 days, he says, was able to end this conflict? So certainly that is what the market is in some ways cheering on, and that we basically have stepped away from a major escalation between U.S. and Iran, as well as Iran and Israel. So certainly that's one thing to watch. But as Jumana mentioned, right, there are still some irreconcilable problems, right? We were just talking to Bernstein as well. They're saying that Israel will not tolerate Iran having a nuclear capability, while the Iranian regime is likely to keep believing that having that nuclear capability is the only way to guarantee security. So where are we still kind of aligned and not aligned is certainly the key question here. And of course, whether this does hold and what we hear from both sides, certainly. But in the meantime, we're still hearing a little bit more about the disruptions around airlines, right? Now, Gulf states have at least talked about reopening some of these airspaces again, but we're still seeing a lot of disruptions. So Japan Airlines, I think, was the one in the last few hours, suspending flights to some Gulf nations. I think Air India also joined in on the fray in the last few hours as well. Yeah, I think we were just speaking to your point, Jumana, earlier on, and it's been quite a, let's call it 24 hours, but going into the weekend, right? Because the prospect of a wider conflict, and I want to use past tense when I say that, did eventually involve, and it's worth pointing out, right? You have a lot of major global airline hubs there, right? So you have Doha for Qatar, you obviously have Dubai for Emirates. You'd even include Turkey. There were Turkish Airlines. So you would imagine really everything that goes through there did get some disruptions, and we understand, of course, some of that is lifted right now. But on an airline basis, I think we are still looking at more idiosyncratic announcements coming through from the airlines themselves. But yes, it is certainly worth paying attention to almost in a sort of granular hour-to-hour detail. But we're in a better place right now compared to 24 hours ago, Yvonne. Yes, certainly in the market's perspective, they think this whole conflict is over in some ways. Is that actually justified? That certainly is a key thing to watch. But yes, airlines, though, are seeing some decent gains here this morning. This is Bloomberg. .29 a.m. in Tokyo, and Japanese markets heading into that lunch break as well. So what we're seeing is a bit of an unwind in those haven plays, right? Particularly when it comes to the yen. So we are back to 145 levels here right now. So that safe haven dollar buying, that is coming off now. And then again, you also have the Fed's Michelle Bowman speaking overnight, supporting rate cuts for the Fed as early as July. So that's put pressure on the dollar as well. That's helping the equity space in Tokyo. But keep in mind, we also have that 20-year bond auction coming up later on as well, Dave.
Yeah, we do. 2045 bonds are going to be on deck today. We'll see what the appetite and the eventual demand looks like. They're in bid to cover. Certainly, we're coming off a very weak one this time in last month. We're also getting more information now on how much 10-year notes they'll be selling out of the finance ministry on July the 1st. That's in about a week or so. 2.6 trillion is the amount that was put out early on, I would say about an hour or so back. Now, to Yvonne's point, it's a day where risk is certainly back into fray and investors embracing risk and risk assets going into the thick of the Tuesday session. Equities are doing very well. We're up about 1% on the broader benchmark. That's going to come up on your screens very shortly, with the exception of the opposite side of the coin, right? So energy was bid, that's on offer, and also gold, because gold was also caught a decent bid of late. We're also seeing that pare back a little bit. So we're up 1.7% now. S&P futures are up at about 61.10. That should be near, but not quite, if memory serves me correct, not quite at session highs right now. Dollar is on weaker footing, and that's really paving the way for more inflows back into markets this side of the world. Okay, we'll table markets there for now. We'll take it now straight to Tianjin and our continuing coverage of the World Economic Forum there. And Stephen Engel is standing by with our next guest. Steve.
Yeah, our next guest is Joe Ngai. He is McKinsey's Greater China chairman. Thanks so much for joining us. So let's get your pulse check on the state of the Chinese economy. There's a lot of external shocks. We all know what's going on in the Middle East. The markets seem to think that maybe we found an off-ramp. The trade war, we don't really have a lasting truce. How would you assess right now the risk appetite of households in China and corporates?
Well, I think the households in China in the last few years, I would say, have kind of weathered many, many storms, right, since COVID and all these. I would say that they're quite desensitized, right? The last 1 year with all these things, I would say the Chinese local domestic economy have kind of chugged along at a kind of moderate pace. I don't think people see any big upside, but neither do I think that they are very disturbed by what's going on. So as we look at things like domestic travel, some of the consumption numbers and all that, I would say that we are at a kind of moderate level and keep going. What I worry about is a little bit around companies, right? Where they're going to make like CapEx decisions,
right.
They can make longer-term decisions. I think those are the ones where some of the uncertainty comes in a little bit.
And the property market's still moribund, right?
Again, right, we're at a level that is kind of stabilized, but there's not a lot of upside that people see right now.
I want to talk about the McKinsey Global Institute identifying 18 arenas for growth in the global economy until 2040, right? So we all know that China's done really well in EVs. They've done really well in batteries. There are claims of overcapacity. You've probably seen the overcapacity in products that the trade war has exacerbated as well for export. What are going to be the industries of the next 15 years or so that are going to see China not only lead, but dominate?
Well, look, I think that if you think about the areas that we think are very interesting for the future, right? These are like the robotics, right? Part of it is Gen AI. A lot of these is biotech. We are very, the latest in terms of industrial manufacturing. I think that China is actually in each one of these. They have spent the last couple of years really investing in those. I think companies have built supply chains, right? And quite a lot of ecosystem around these. So if you look at these are battlegrounds of the future. And China is quite well positioned in these. Now, The downside is that there's been a lot of investment coming in, so therefore they need to look for markets, right? And that's going to be where you're going to find global markets, right? Right now, what you see in the last couple of years are like China and ASEAN, that trade route, ASEAN and the Middle East, China and LATAM. So I do think that I've never seen a period of time where Chinese companies are so eager to go overseas because they need to find a bigger market for all the investments that they've made.
How do they best find the domestic market being the best market? Because, again, there's all those export products, and I spoke to JD.com vice president and chief economist earlier who essentially said they're trying to buy up a lot of those export-bound products and then resell them into the domestic market. Or are people too cautious?
Well, I think that there are many dimensions to this. I think on the one hand, I think for Chinese companies, as they're going overseas, I call this, 20 years ago, China was like the factory for the world, right? These days, I think the Chinese companies need to think of themselves much more like a corporate citizen of the world, right? So on the one hand, you have hard goods that you're exporting, but there's also good technologies, they're good IP, you got to do a lot more joint ventures, you do a lot more collaboration, you got to figure out how you play into the industrial policies of many foreign markets. And that's what they got to learn and do better in. Because having a better corporate citizen of the world will make Chinese companies that much more attractive.
Yeah, industrial policy usually follows industrial state policy, right? So how much is this embodied AI going to be the next one? Because, again, China has a lot of engineers, but they're also seeing a shortage on an industry right now that seems on the surface of things going to be a next driver.
I think the world is running out of engineers, but in some ways, China, does have on relative basis like a lot of engineering graduates every year at a kind of salary level that is actually quite good value for money. So as I talk to a lot of companies around the world, I think that China still had some advantage around like the engineering talent that's coming out. Maybe with exception with India is coming close as well. So I do think that that's going to be where battles will be fought. But I think the other one I think is quite interesting is that with DeepSeek in the last few months, I think that ushered in a whole corporate culture where we're trying many Gen AI use cases. I don't go into any Chinese company or any boardroom right now without that being part of the discussion. And I think that right now, if I were to think about any Chinese boardroom, any Chinese company, they're thinking around whether Gen AI would be the next curve of productivity increases to them.
Right, because what I've been looking into some of these little dragons in the Hangzhou area of AI, yes, there is a DeepSeek moment, but how do you monetize that, right?
I totally agree. So, I think that right now we have all sorts of labs and PhDs who are working on these things. When would this ever impact the bottom line or have like real impact? I think that's the question. And by the way, it's not a Chinese question. That's a question that we have all around the world because I think Gen AI has lots of promise. I think that we're very wowed by the initial use case of it. But I think for that to trickle down into real corporate balance sheets, I think that we're still waiting for that.
Where's the private equity money going? I know you used to lead the private equity division at McKinsey here in Asia. We know where policy's going. I haven't met a single Chinese policymaker who doesn't mention DeepSeek, right? So we can kind of see, okay, money's going to go into there. But where's the private money going?
I think private money is still very excited about a few areas. I think if I think about areas where people feel like, Chinese companies have a distinctive edge, right? I think recently, to be honest, biotech has been an area that people are quite fascinated about because, for the same kind of value for money, I think that, Chinese biotech innovations have actually been quite leading. The other one I think is really, we go back a little bit to this whole robotics. It's not only called AI, but it's really around the whole manufacturing, right, of the robots. I think the Chinese robots will come into the world, in a way that as a price for money and price of value, that will be quite unbeatable. So I think those areas, we're very enthusiastic. But another area which I think is quite interesting is where I talk about Chinese companies and how the collaboration is going to work. I think that there's a lot of Chinese IP and I also call capabilities that are being built that can actually collaborate with foreign companies. So I see a lot of joint ventures being established in countries around the world with Chinese technology and with a lot of foreign capital. And that's where I think that's next PE is going to go.
I just want to pick up on that humanoid robot situation because I went to Mobile World Congress. There were no handsets around. They were all humanoid robots, embodied AI, right? And some study that I saw that 90% of the components and parts of that, the supply chain's in China.
And that's where I think that China has advantage in terms of the capacity that's
over
being built.
Optimus from whatever the United States and Elon Musk produces?
At the price level, I think that that's going to be at a fraction of what that is. And remember, this is not only around the robots itself, right? All the components, all the parts, the manufacturing capacity, and also, to be honest, right, even the machinery behind that, right? So I think that whole chain has been built over the last few years, and that's where I think that we'll see robots in China becoming our household companions a lot sooner than you'll see that around the world, just because I think that there is so much interest, right, and money going in there that they'll come out at a price point that'll be very surprising.
Joe Ngai, thanks so much for your time.
Thank you.
It's fascinating times, right?
Absolutely.
All right, Joe Ngai of McKinsey. He's the Greater China Chairman here at the World Economic Forum, Summer Davos in Tianjin. Back to you guys.
Great stuff, Steve. And thanks, of course, to bringing that interview to our shows. And subscribers can really watch us live and rewatch some of those interviews on our interactive TV function, TV Go. You can dive into any of the securities or Bloomberg functions that we talk about and become part of the conversation. Send us messages or questions for our guests as well throughout the morning. Check it out at TV Go.
Welcome back. You're watching the China Show. A look at this rally we're seeing across the Asia Pacific, led by this one specific market on your screens. South Korea resuming the uptrend and the bull market we're seeing here, 2.5% now on the Kospi index, should be at session highs. Samsung is up 3.5%. SK Hynix is up 8%. Kakao is up 21%. So in terms of points gainers, those are really leading this rally taking place. And what memory serves me correct, still the best performing markets near the top of the world year to date. And yeah, I think we're now at 85 on the 14-day relative strength index, which is way past, of course, at 70 handle. But yeah, there is a lot of momentum behind this trade run, this long Korea trade, Yvonne.
Yeah, it seems like they're still coming back in a big way. And let's move on and talk a little bit more about what's happening in China here this morning. Now, they have introduced a requirement for state-owned developers to avoid defaulting on publicly issued debt in the latest attempt by authorities to contain the nation's prolonged property crisis. Let's bring in our China correspondent, Min Lo, to tell us more about this new directive. And is the government actually coming through with assistance to help with these firms avoid a default?
Yeah, interestingly, no. They're not indicating that they're prepared to provide any measures and assistance to backstop these developers, but they are issuing this directive, though, to about 20 developers, according to sources, and issuing a series of metrics, including, for example, total profits, debt-to-asset ratios that the companies will have to meet. So you can see this as perhaps a form of warning to some of the officials leading the state-owned enterprises that their performance are going to be held accountable, perhaps a hint to the lenders and the banks as well that are in charge of rolling over debt or issuing credit to the developers. And it shows you the urgency that the Chinese government is facing now in trying to rein in the credit risk after 4 years of the property crisis. We have seen all these private developers since 2021 defaulting and sitting on about close to $140 billion of distressed debt. But so far, the state-owned enterprises, they have not been affected to the same extent, and I think that's the way that the government wants to keep it for now.
So how at risk are these SOEs right now, and how bad are they impacted by this housing slump?
Yeah, I mean, if you look at the broad data for May, home prices, home sales were both negative, and our in-house analyst, Christy Hung from Bloomberg Intelligence, was saying that she sees the risk for both private developers and state-owned enterprises to possibly have negative growth this year for the full year. Already in the first 5 months of the year, we saw a 5% decline in growth for state-owned enterprises. So in particular, it is the smaller firms that are at risk, because just a few months ago, there was one state-owned enterprise, CCC, PCG, it was at risk of being delisted from the Shenzhen Stock Exchange, the first state-owned enterprise to actually receive such a warning from the boss because its net equity turned negative. But it managed to stay on after it sold off the entire real estate division to a parent company. But it shows you, if you look at the local government-owned enterprises, these are the ones whose bonds yields are at the highest of 32 sectors, according to CICC, whereas the centrally owned enterprises, those are the ones that are trading still near to or on par. So it's the provincial government-owned ones that are most at risk, at least according to investors' expectations.
Min, thank you so much. Min Lo, our China correspondent, there on the latest on that specific story. Okay, this oil market keeps giving. So, for very obvious reasons, very much in focus today. Gap lower in Brent. Let me tell you so. Gap lower in Brent today. So we opened below 70, and now, as I speak, we are back above 70. Well, session highs on Brent, 70.11 right now is where we are. So yes, we have retraced all the way down, but a reminder, I guess, that this is still a very fluid story, that we haven't quite crossed all the T's and dotted the I's on this as well. Now, the background here is Donald Trump, of course, announcing that ceasefire between the two. And we're still waiting to hear confirmation, of course, from the Israeli side specifically on where the story goes as the deadline looms in about an hour time, of course, for that ceasefire. Not deadline, well, of course, the specific timestamp for when that ceasefire is supposed to be in effect. Let's bring in Nicholas Lu, our oil reporter in Singapore, for us to talk us through. And Nicholas, why don't we start with the moves today? Why are we seeing this, well, the sell-off so pronounced, but we're coming off lows of the day? What do you think is going on here? Okay, yeah.
I think we're having some audio issues here right now.
Yeah. Go ahead, Yvonne.
But yes, obviously we're talking about the oil markets here. It's interesting just, how the sell-off has really been so a bit of a big move and this whiplash that we're seeing across oil markets. And we'll talk to Nicholas about that a little bit, right? Because you look at the Brent prompt spreads, David, we were talking about this earlier before the show started. They've narrowed a bit, but we're still seeing backwardation. So that is still a bullish pattern. So does that mean that there still is a bit of runway for these oil prices to head higher? That certainly is one thing. But then everyone keeps talking about, look, now that we've kind of put the geopolitics aside, we got to focus more on the fundamentals now.
Yeah, and I think the point that Bernstein was making earlier on, right, Neil Beveridge, was it's, the reaction in the oil curve tells us very much about where the reaction is as far as oil price, but what it means for equity, for the equity complex here, as far as the backward end of or the back end of the futures curve, where that's where the valuation is derived from when you look at the equity complex. I think we had the chart that Yvonne was mentioning early on. I'm just going to cue that for our producers. Can you guys bring up 4232, please? Because that really is, in many ways, it tells you on this specific gauge that we're back to about $1. So the market has priced out mostly the tensions, but the fact that it is still in backwardation gives you a sense of what the weakness in the fundamental story is. I'll use this as a jump-off point to bring Nicholas Lua back in, and we hope that we've sorted out all the technical gremlins here. Nicholas, do you hear us? And yes, why has the sell-off been so pronounced, and what do you make of this move in the last 15 minutes or so, this move up ever so slightly from the lows?
Right. Hi, David. I hope you can hear me now. I think what's important to flag is, as you said, Israel hasn't actually given any new comment on the matter. And not to forget, Israel was the one who started this round of the conflict, right? So in some ways, as we've seen, Iran's nuclear bases have been subjected to massive attacks from the US, and it seems like their capacities have been mostly neutralized. So it makes sense that they would be the ones willing to agree to a de-escalation. But I think, as you said, things are fluid, and until we hear from Israel, there is some uncertainty leading to the retracement we've seen in the spreads as well as in the flat price.
Yep. So any sort of confirmation from Israel, what else? What other factors, Nicholas, are your team looking out for moving forward?
I think it's important to recognize that, leaving aside this Middle East conflict, the broader pattern is that the market in oil is looking very bearish. Don't forget that a while back, OPEC has already announced massive super-sized capacity increases, and those are set to lead the oil market supply to be plentiful. There have been minimal disruptions on the Iran front, so most of Iran's oil refining capacity remains intact. And so it looks like fundamentals are destined to reassert their impact. And again, we are looking at potentially flabby second half of the year.
Nicholas, thank you. Nicholas Lua there, our Bloomberg oil reporter, joining us with the latest out of Singapore. We got plenty more ahead. This is Bloomberg. All right, we are just about an hour away from that ceasefire set to begin between Israel and Iran, Dave. It's going to be quite telling whether it holds. You know, they talk about this is sort of a pause here right now, but certainly, you know, President Trump wants to call this a foreign policy success on his part and calling it just a 12-day war. So are we on the path of some sort of end of this conflict? Is still up in the air right now, but markets are certainly liking that news so far. But key to watch, of course, as we've been talking about throughout the hours, is Israel's response. We haven't heard from the official confirmation yet of where they stand in all of this.
Yeah, and I think that the point you're making, what we've heard so far since the ceasefire announcement was made from President Trump, and this is just, I guess, an interesting juxtaposition to that. The only thing we've heard is out of the IDF talking about how missiles launched from Iran a short while ago, right? And before that, even we did hear, of course, also from the Iranian side about explosions in Tehran. So again, the ceasefire, we're still counting down to that. But how do both sides look at what's taking place in the last, let's call it, hour or so, and the exchange still of military action there? Is that the last of it, or do both sides take it in good faith? I think is the other question altogether. What I'm wondering personally.
Yeah, markets have been really focused on the Iran response in the last 24 hours, right? The fact that it was U.S. bases in Qatar, it was widely telegraphed, it was largely symbolic according to Bloomberg Economics as well. So that in itself showed maybe, the fact that oil flows are still going and the Strait of Hormuz was not impacted any way. Is that a sign that Iran is not willing to use oil as a weapon in this conflict? It seems like the market says yes, that certainly is the narrative right now, and that's why we're seeing this plunge in oil. But as you mentioned, right, we're off some of the lows, so potentially there is still a little bit of that war premium still being priced in.
Yeah. I mean, how quickly we have swung between 150 on the extreme side to now $50 on the other side of that spectrum, and I guess it just goes to show like the headline risk still. But point being is, we are in a better position from 24 hours ago. That's number one. And I think that while there are fundamental still outstanding items still here, right, to the point that Jomana, our colleague, was making out of Dubai, like where is that uranium, for example, that we know that they moved before that took place, and what does it mean for the broader conversation around nuclear? But yes, we will, I guess, almost done for the show. A quick glance, I guess, at the Hang Seng Index before we wrap things up here, and we pass it on to, of course, our other colleagues to continue the story as we count down to that ceasefire taking effect. The Hang Seng Index is better by about 1%. The rest of the region also doing quite well.